is a reality. I'm saying that, we enjoy one of the best, qualities of life in this country, and that comes at a cost. Okay, somebody has to pay for it, and it comes from tax revenue, right? This is why we enjoy the quality of life that we do. So there's nothing wrong with paying taxes. Now, mind you, we're not suggesting that you not pay taxes. It's biblical to pay taxes. And the Lord Himself said, "Give to Caesar what belongs to Caesar," right? So we want to pay tax, but within the tax rules, okay, and wherever the government wants to steer the economy in a certain direction, it comes up with the incentives to make you go in that direction, okay? And what we're doing is we're just using their rules to our benefit, okay, without avoiding tax. You follow? We're just playing by the rules here. So does it exist? Absolutely. Can you defer income tax? Yes, in 3 ways. The first one is to RSPs, Registered Retirement Savings Plan. Now, what is it? It's a savings plan that has 2 features in it. If you go to a bank and you say, "Open a savings account for me," they will open a savings account, except that it's just a open savings account. But if you tell them, "Please make it a registered retirement savings account," 2 things are going to happen. Every dollar that you put in, at the end of the year, instead of getting a T5 to report income, you're going to get a T4 RSP to be able to deduct that money off your taxes. Okay? So if you make $10,000 and you put in $1,000 into an RSP, right? At the end of the year, you're going to get a T4 RSP for $1,000. So when you report your taxes, you say, "I made $10,000. Here's an RSP receipt for $1,000. I only have to pay tax on $9,000. You follow? So that's the first feature. The second feature is the $1,000 that you put into that savings account, which is an RSP account, it's going to earn interest, 1.2%, but it does earn interest, right? At the end of the year, you don't have to report that interest. They're not going to send you a T5. Okay? So these are the 2 features that make this interesting. Now, it came about in 1957 because planners at that time realized that we have these baby boomers who came after the World War, in Canada, or 9 million of them, who are going to get at the same time. And unless we, if this batch goes into retirement without adequate savings, we're going to have a problem because a lot of them are going to depend on society because they don't have, they cannot work anymore. So to encourage that, the government came up with this registered retirement savings plan. They said, we are going to forego tax revenue because you're going to get a deduction. We can't tax you on $10,000, we can only tax you on $9,000. We're going to forego tax revenue, but we want to be in a worse situation down the road. Okay, to encourage people to do this. So it began in 1957, and it's been changing. So here are some of the basics of it. It's evolved over time. Okay, like over time, every budget comes up and make changes to it. So at this stage of the game, this is how some of the basics are, how it sits. You are allowed to contribute up to 18% of your previous year's income, okay, to a maximum for the current year. So this year, in 2011, okay, you can contribute up to $22,450. It's not an absolute amount. That is based on 18% of your previous year's income. So if last year, in 2010, okay, the year 2010, you only made $100,000, 18% of that is $18,000. So you can put in $18,000. Okay. The highest you can put is $22,450, but limited to 80% of your previous income. Okay. So if you make more than if I made more than $125,000 last year, okay, 80% of that would be, let's say, $23,000. Okay, 18% will be 23. I'm still limited by the limit of 2011, 22,450. So the most anyone can put in, okay, is 22,450. But if you make less than 123,000, it's limited by 18%. Okay, that's just the order. Now next year it's going to go up to 22,950 based on 2011's income, 18%, and thereafter they're going to index it for inflation. The 22,950 is going to be indexed for inflation, right? Since 1991, they've had this carryover provision because people were not using the maximum 18% because they don't have the money. And so the government decided, especially for people with fluctuating incomes, they might have a bad year one year, a good year another year, they said that starting 1991, if you didn't use your entire 18%, that amount gets carried over to the following years, unlimited. So all of us, most people are sitting with quite a bit of RSP contribution room. Whenever you get your tax return, it tells you what your total amount is, okay? Based on 18% of the previous year and all the previous year's accumulation. So all of us are sitting with a minimum $50,000 to $100,000 of RSP contribution rules, which is one of the things that we're going to talk about when we talk about strategies and how we use them. Now, there's also the other thing that you have to be aware of is when you open an RSP account, you can leave it open and let money accumulate that tax-free, and you add money, you get it. When you add fresh money, you get a deduction, and the money that's in there can accumulate tax-free, however you've invested it, okay, until the end of the year in which you turn 71. Okay? So usually for people who are turning 75, turn 71 this year, by December 31st of this year, of the year in which I turn 71, I have to do something with that money. Convert it into a pension, private pension, called a RIF or an annuity. Okay, and now we've got new products coming out called guaranteed minimum withdrawal lifetime amount. You see ads on TV, insurance companies are running their lifetime income. That's what they mean. Okay? But you're taking these RSPs and converting them into a private pension that gives you a monthly income for the rest of your life. Okay? And you have to do that. Because if you don't do it, it's automatically deregistered. Okay? On January 1st of the year which you turn 72. And that can create a problem. Because if you have $250,000 in there, and if you didn't do anything, you are in default the following year. Because for the following year, in the 72nd year, you have to report the whole thing one shot. And you don't want to be doing that. You don't want to do that. Alright. So these are some of the basics. Where can you put the money? You can put it in the savings account, you can put it in term deposits, you can put it in a mutual fund, you can put it in stocks. Okay? Those are the main ones. Main investment vehicle, oil and bonds. Some people are sophisticated and they set up what's called a self-directed plan, okay, where you go to a bank or financial institution and you tell them you want a self-directed plan. They charge you a fee for it, like maybe $100 a month for the administration, but you get to call the shots where the money is invested. So you might say, my $10,000, I want to put $1,000 in savings, $1,000 in mutual funds, you do it. Okay? In our process, in our thinking here, we will not be doing that. Okay? We discourage self. We want to keep things very, very simple, tax efficient, guaranteed, with a minimum risk possible with a maximum return. Okay? This is where we're headed. Because if you get into self-directed plans, you're just opening a can of worms. It's gonna, you've got to know the information is moving too fast, and you always look on the tail end of things. Okay? You can't win at that game. All right. There are spousal plans for people who make money, but then they have a spouse who's not making money. They call them spousal plans, where I set up a plan in my wife's name, but I get a deduction because I don't have any income. Okay? But the RSP really belongs to my wife. And the reason for that is on the back end, when you take the money out, usually when you have the spouse is earning the income, he also has a pension plan at work, right? So if everything is in his name, then on the back end, when you start taking it out, everything will fall in his name too. So to balance it out, they allow the spousal plan. Okay? You get the deduction now, and the back end is split. The spouse gets one half and you get the other. Right? Now, those are the basics, and these are continuously changing. And just be aware of them, and they're easy. If you have access to them very easily today with information, then you can go to any financial institution's website and you can get all these basics, the most current information that you need. But I think what's more interesting are some RSP strategies that you might not be aware of. Okay, the first one is this. Use your maximum limits each year. Now we come to borrowing. Remember I said, we want to borrow, don't want to borrow, we want to stay out of debt. I'm going to contradict myself here. When I say don't borrow, I'm talking about consumer borrowing, consumption. Okay? Don't borrow to consume. Okay? But here, as a strategy, it does make sense. Well, I'll tell you why it makes sense. Most people don't use the RSP limits each year. Why do they not use it? Because they don't have the money. It's not difficult easy to come up with 18% of your previous year's income. Last year I made $100,000, and chances of this year I'm making about that. To come up with $18,000 is a lot of money, right? So most people don't do it, and they buy a small amount because they don't have the money. I'm going to suggest that you consider RSP loans, okay, over 1 year. Okay? Structure this right, because you don't want to get hung up with unnecessary debt. And here's why my thinking is. Because most RSP loans, when the financial institutions come up during RSP seasons, they lend it at prime plus 1 or 2%, okay? Because they want to get the business. So it's a fairly good rate. So today prime is about 3%, so you get a loan at about 4 or 5%, okay, over 1 year. So why do I suggest that you do it? Because immediately you're going to save 20. If you're in a low income tax bracket, you're going to save 20% in taxes. Okay? And if you're in a high income tax bracket, you're going to save 50% in tax. So let me give you an example. So let's say my RSP limit is $10,000, but I don't have $10,000, right? So what I do is I go to my financial institution, I say, let's say assuming my cash flow allows me to carry this over 1 year. You don't want to bite more than you can chew. So assuming you've paid off all of your debts and you have the cash flow and you can afford, let's say, $800 a month, carrying this over 1 year, you go out and borrow $10,000. As soon as you buy the RSP, okay, if you are in the 50% tax bracket, you're going to save $5,000 in taxes. When you get your refund, you're going to get $5,000 more, right? So here's the strategy. You open the RSP, you borrow $10,000, you're paying it up over 1 year, make it an open loan. As soon as your refund comes back, dump it on the loan. So suddenly now you've got an RSP of $10,000 on which you owe $10,000. As soon as your refund comes back, you only owe $5,000. You just built $5,000 of equity. You just sucked back $5,000 that was going to the government back into your account. Does that make sense? It's wealth. You're building wealth. This is how you do it. Okay? So that's the only reason you would do it. Okay? And now that your loan that you borrowed $10,000, the loan was $10,000, it's now gone down to $5,000, okay? And you're making $800 payments. Before the 12 months up, it's paid. You understand? Do that again every year, and you're building wealth. So, without getting stuck in there. So, caveat here, make sure that you can handle the cash flow. Okay? If you've got a credit card that you're still at step number 4, doing the rigors that don't do this. Okay? You need to clear that first. Clear up all of your debts, build your emergency fund. You've got the cash flow. Open your eyes, make sure you can handle the monthly payment, structure it, then you can handle it. Here's the reason why you do it. With the left hand, I'm paying 5%. With the right hand, immediately I'm saving 20 to 50%. Okay? And you're ahead of the game. Alright? So that's the first strategy. The second strategy, particularly if you have fluctuating incomes, if you're self-employed or if you're doing more than one job or you've got other sources of income, or you get a windfall, and in a particular year, you got thrown into a higher tax bracket. For whatever reason, and sometimes you sell something or property. If in a year you got a bump in a higher tax bracket, okay? And in next session, this is why it's imperative that you attend next session, because if you are going about there not even understanding how our tax system works, you cannot maneuver. You don't know how to play the game if you don't know what the rules are. Okay? And without getting complicated next week, I'm going to show you how our tax system works. Once you understand how it works, then you know how to play the game. And one of the things that happen is our system is a progressive tax rate. The more money you make, the higher the tax bracket is. And so the idea is to go back into the lower level, right? And one of the ways you do this is by using your unused contribution. And so there's a way to create a tax holiday. Either pay zero tax or get rid of the bumps in the higher years by using the unused contribution rule. Okay? Now, all of us have a lot, so you contribute enough so that you reduce your taxable income to zero for that year. Let me give you an example of what I'm saying. Let's say I normally make $75,000. Yeah? And this particular year, because I sold some investments or whatever the reason, I'm in the highest tax bracket. Okay? I ended up making $150,000 because of overtime or whatever the reason. Okay? So I ended up making $150,000. I've got a big tax bill coming my way, especially if you didn't make it at the same source. You made it at another source because they didn't balance it up properly. You're going to have a tax bill coming your way. Okay? If that happens, what you do is use your unused contribution rule. You're going to take a loan. Okay? Again, this is always done only if you finish all these steps. Okay? You build, you're past step 6 here. Okay? You're at step 7 here now, right? If you haven't passed step 6, don't do this. This is not for you. You've got bigger fish to fry. Okay? Take care of other things, otherwise you're going to be in a bigger mess. If you are at step 7 and you're there, this is what you do. You take all of us, like I said, have a huge chunk of unused contribution. So let me give you an example. I made $150,000 this year, and if I knock off all I'm an employee, so the only deductions I have are personal exemptions and whatnot. So my taxable income is about $140,000. Okay? So I owe about $70,000 in taxes after that. Okay? That's a lot of money to be giving away to the government. So here's what I do. I look at my RSP contribution group and I say, wait, since 1991, I haven't been using it, and there's about $400,000 there, right? So what I do is I go out and get into financial institutions, and this is part of planning. Okay? I have got a tax liability, a taxable income of $140,000. I take a $140,000 loan, almost like a mortgage, over 10 years. Again, assuming we can afford this, right? So now I take an RSP loan over 10 years and assuming I can carry the monthly payments, it becomes a forced saving. I'm going to get a tax receipt for a T4 RSP for $140,000. But I have the rule, see? Because I haven't been contributing since 1991. So I go and borrow $140,000 over 10 years. That's the only way they're going to make the payments manageable, right? So that year, I'm going to report income of $150,000, personal exemptions of $10,000, so my taxable income is $140,000. If I didn't do this, I'm going to end up paying $70,000 in taxes, right? But in this case, because I took an RSP loan of $140,000, my taxable income is zero. You follow? So instead of owing them $70,000, I owe them nothing. And not only that, okay, whatever taxes they took, I'm assuming if they took, let's say, if you do this in 2 places, chances are it's going to be a shortfall. So let's say they took $50,000 in taxes along the way at source, right? As a result of that, that $50,000 comes back as a refund. So as soon as I get that $50,000 refund, guess what I do? My loan is $140,000. I apply it against my loan. So your net worth just went up by, and so now you're carrying this loan. You took 140, you take down 50, so you got a $90,000 loan. And handle it whichever you want. Okay? If you stay focused on paying it off quickly, your net worth just went up. Now you do that a few times in life. Okay, once every 10 years, one every 5 years. That's another way to increase your net worth. These are creative ways. Again, I warn you, don't do this until you take step number 6. Okay? Because otherwise, you're out of the frying pan into the fire. Okay? Be very careful. All right. The third one, very quickly, is what's called an RSP meltdown strategy. An RSP meltdown is what it is. See, what happens in an RSP is, it's great, you're enjoying it because you're getting a deduction every year. You're getting a deduction every year. Right? Technology. You're getting a deduction every year, and it's nice. Okay? But at the end of the day, you have to take the money out. Okay? And when you take the money out of the RSP, it's fully taxable. Okay? So whenever let's say when I'm ready to retire, whether it's age 71 or age 55 or 60, and I say I need an additional source of income, and let's say I go to my RSPs and say, from all the sources of money that I have, I need an additional $1,000 out of my RSP. Okay? That $1,000 is fully taxable. You follow? Because you got a deduction on the way in. Now, every dollar that you take out of the RSP is 100% taxable. You have to report on the tax returns. The RSP meltdown is a way to convert that from 100% taxable to 50% taxable. So we bring it up and I'll go to the board and I'll show you how that's done. Okay. It's a way I'm not going to go there. I suspect it's going to take me to the next. to 50% taxable. So this is how it's done. So I've got an RSP, and I'm ready to retire, or to start using it, or I want to withdraw from it. But the only problem is, if I take it out, I have to pay tax on it. Okay? And it's going to throw me to a high tax bracket, especially if I've got other sources of income. So one of the planning that we do is to convert that from 100% taxable to 50% taxable. So I've got an RSP here. And let's say I've got an RSP, and I'm just going to use a number here. It's worth $100,000. Okay? In this first scenario, if I take this $100,000 out, okay, whether in one lump sum or over time, I pay tax on it. And let's say the tax is 50%, and so I end up with only $50,000. Right? And that's because this is 100% taxable. Every dollar is taxable at the highest tax rate, and that's what I pay. A way to convert that to 50% is to the RSP meltdown, where we do this. Is that instead of doing this, we're going to take the RSP, okay, and we're going to set up, let's say this is in investment A. It's invested in investment A, in a fund, right? We're going to create another fund. We're going to buy another fund, same fund, investment A, right? We're going to buy another fund. But we're going to do this for the same amount, 100,000. Where this is an RSP, this is non-registered. Okay. So you've got $100,000 in your RSP in investment A. So you're going to borrow $100,000, okay, and put it in the same investment but non-registered. Same institution, just say, I want the same thing but not an RSP. Okay? Now, where's the $100,000 going to come from? We're going to borrow it. And buddy said, if I borrow it, I have to pay it. Where's the money going to come from to pay it? We're going to melt this down. So what we do is we go to the RSP, and we've got computer models that do this, and where we make one sync to the other. So that the payment from here, let's say the monthly payment is for this amount, depending on the term, let's say we do this over 3 years, or 4 years, or 5 years, or 6 years. Usually we do it over 15. Okay? But we melt this down over 15. So let's say over 15 years, the monthly payment is $750. So it's $500. Okay? So what I do to my RSP is I go to my RSP, we set up a bank account, okay? And we tell the RSP, we direct the RSP holder, okay, the institution, to take out $500 every month and put it. I usually set up in a PC account, which has got no special account for this. Okay? Go to PC Financial, set up an account, there's no monthly fee and whatnot, and you direct your RSP to put in $500 every month. Okay? So our $500 is going in, and then you set up this loan, and we design it in a way that the loan payment is also $500. And we ask the loan to take it directly from here. Okay, so it's going to pay that loan. Well, so every month, $500 is coming out of your RSP into your PC Financial account, checking account. And every month, this loan is being paid off. Right? And so let's say this investment is earning 10%, and this investment is also earning 10%. Okay? So in 10%, at the rule of 72, in 15 years, it's going to double twice. Because at 10%, money doubles every 7 years. So in 15 years, there's 2 doubling. Okay? So at the end of 10, 15 years, 1 doubling becomes 200, 2 doubling, this becomes 400. The investment grows to $400,000. Am I right? Sure. Okay. Now on the other hand, however, we designed this that if we're taking out $500 every month, okay, in a year we're taking out $6,000. At the end of 15 years, this will go down to 0. Okay? So the RSP is depleted. It's 0 now. Okay? So at the end of 15 years, we do our accounting now. In this scenario, if I didn't do this, okay, if I went here to take my money out, I could pay 50% tax, I end up with $50,000. If I did this without it costing me anything, right, I've melted down my RSP. Now I'm ready to do the same thing. Okay, I come here, the government is going to say to me, hey, this is a non-registered plan, okay? And the next thing we're going to talk about is capital growth. Okay? You started with $100,000. It's now worth $400,000. So $300,000 is what's called a capital gain, right? A capital gain. That's a capital. You put in $100,000 in capital, you gain $300,000. Capital gains are only 50% taxable. Okay? So the tax on this is $150,000, right? Okay? So you're still left with $250,000. Okay? So at the end of the day, okay, if you go this route, you end up with $50,000. If you go the RRSP meltdown route, which didn't cost you anything, you just took money from one place, paid the other, converted one from an RRSP to a non-RRSP, you end up 5 times more. Oh. This is assuming you took it all out of one shot. Even if you spread it over your lifetime, the point that I'm making is you've converted an RRSP dollar, which is 100% taxable, to capital gains, which is only 50% taxable. Does that make sense? If you're seeing this for the first time, it might be overwhelming. But the idea is it's just a strategy. Okay? For people who've done the time, okay, who are in a position to do this, because we always don't want to be caught up with debt. You know? And if you do this when you haven't cleaned up your act first, it won't work. You're just going to find yourself in bigger messes. But when you're ready to do this, these are all the fine-tuning, okay, that will just increase your cash at the end. Right? So that's the RRSP structures. Now, the next way to make money tax-free is what's called a tax-free registered retirement savings plan. Now, whenever we talk about registered education savings plan, people think of children, okay, but not necessarily. I've seen a lot of adults here, whether or not you have children. If you have kids, it applies there too, because the average student comes up with a $50,000 loan, okay? And if you have kids, and we love our kids, and if it's at all possible, try to use this. An RESP for kids makes sense because of the government grant. The government gives you every dollar that you put in since 1998. The government adds 20%. Gives you 20% of that up to a maximum of 7. That's free money. Yeah? So if you've got a kid, or a child, or a grandchild, or somebody you care about and you want to help them, great way to do it. Okay? But beyond that, okay, for those of us who've got a process here, you know, one of the ways that we're going to increase what we're going to have at the end is by paying the least amount of tax. And even as an adult, you can use this. Okay? Because when you open an RESP account, it can remain open for up to 31 years. Okay? But unlike an RSP, the money that you put in, right? The money that you put in, so here are some of the basics. Let me go through that first. The money, the contributions are not tax deductible. Are not tax deductible. So when you put the money in, unlike the RSP, when you put money in, you get to deduct the money of your taxes. When you put money in an RESP, you don't get to deduct it. But the second part of it, where you don't get a T5, still holds. Okay? You don't get a T5. The earnings accumulate tax-free until you withdraw from the plan, just like in an RSP. Not as good as an RSP, but the next best thing. So we do the RSP first because we get the immediate deduction. But here's another way to defer taxes. Why pay taxes now when you pay it later, 31 years later? Okay? And we've got more ways to maneuver around this, right? The maximum you can put in is $50,000, right? And there's no annual contribution. If you've got $50,000, you get a windfall. You know, this is why people, they don't know what to do with it. And before they know it, the tax bullets are coming their way. Dump it into an RSP. So you'll want it, especially if you've maxed out all your other avenues like RSP limits and TFSA limits and whatnot. Here's the way to do it. Okay? And you put it up to $50,000. Right? Okay. The time can remain, and I talked about the so the last one that you may not be aware of in terms of deferred tax income is what's called unrealized capital gains. when you are ready, if you do go into that strategy that I talked about, stock market investing or real estate investing, um, the, the increase in value of assets, okay, whether it's stocks, bonds, real estate, land, or whatever property that you find, the increase in value is not taxable until you sell it. Okay? Now, a lot of people don't realize that that's a way to defer tax, because if you don't need the money, you don't take it out, don't sell it. You just let it grow, because there's no accounting until you sell it. Warren Buffett, who's the richest man in the world, whose main thing is stock, is a stock picker, he invests in stocks, right? He owes billions of dollars in tax, which he probably will not pay because of legal structures that have been set up and whatnot. But, for instance, he bought shares in Coca-Cola shares in 1998, right? And they've gone like increased in value, so much value from the time he bought it. All of that gain, he hasn't paid any tax. But the day he sells it, you'll have to pay tax. So it's a way to defer, okay? And a lot of time can be good. Now, if you have a business, if you start a business, okay, and that business grows in value, and you sell that business, that's also a capital gain. Well, now, this is to be distinguished from income from these sources. The income from these sources, whether it's a stock, a bond, or a business, or rental income, all of these have to be reported as you earn them, because we are functioning on an accrual basis. As soon as it's earned, it has to be reported, but not the increase in value. The only time you report it is when you sell it, right? And as a result, it creates an opportunity to defer taxes because they remain unrealized. And only 50%, the other thing about capital gains is increase in value is, as opposed to interest income or dividend income or earned income, where all of it is taxable, this is only 50% taxable. Okay? Because the government wants to promote investments. Okay? They want to encourage people to invest, and they're telling them that if it goes up in value, we're only going to tax you 50%. So people have an incentive to want to do it because they're usually a higher risk investments. All right. Now with that, I'll bring this to a close. Are there any questions? On anything we did today? First of all, the GPS process. The GPS process. Any questions? Anybody?
Yeah, I would see. How does it work if I become an adult and I sell higher? How can I get the money?
Whenever you can, if you take when you take the money out, it has to be used for educational purposes. Now, when they first started this, they were very rigid. It had to be a university, tertiary education. Now they become very flexible. They're very flexible in the sense that as long as it's a 3-week course, okay, you can take the money out. And I've seen people take money out to go to a wine course in Italy or in France, wine tasting course. So instead of being rigid at one, it doesn't violate the principles. There are 2 principles there. One is the one to give to safe education for kids, and they encourage you by giving you money so that your children, grandchildren do not end up in debt. And the second was to encourage you to save. It's an incentive to save, which is why they opened it up to that. Also, when you take the money out, if you don't use it for education purposes, all that happens is if you got government money, that is clawback. Okay? If you got the $7,200, that's clawback. Right? Now,
so the capital you put in is yours.
The capital you're not taxed because you never got a deduction. You're paying, when you take it out for non-educational purposes, you cannot justify it, you are taxed only on your thing, and any grant money that you got is clawback. You have to return it. That's the nothing to do. Now, for those of you who have children or grandchildren, or there are kids under 18 years old that you care about, whose education that you're concerned about, whether nephew, niece, or whatever, there is a company out there called Industrial Alliance that does something very different, and you might want to use that as a strategy, because they, in addition to the government grant, they kick in another 15%. Okay? So the more money we have, the better it is. And they're the only ones 5 years old, at the end of the 17th year, they'll look at all the money that you put in your deposits, and based on your total deposits, they'll put in another 15%. So you've got $7,200 coming from the government, 15% coming from them, plus the money that they put in, plus all the growth. Your child or grandchild, whoever you care about, stands a chance. Versus, at least for the first few years, you're going to go into excessive debt. Right? Any other questions on what we did today?
I'll think about life insurance. What happens when you relocate? Say, for example, I had a life insurance there, and I was going to this strategy. What happens if I relocate back to Nigeria, for example?
Right. The currency, as long as you pay your premiums, and as long as you didn't violate the contract in any way, it continues. You can pay from wherever. The currency that they pay it out in will be in Canadian currency. And as long as you keep it up, there's no reason for them to do anything. The only thing is it will be paid out in Canadian currency. Now, the other thing also is, if death occurs here, it's very easy because you can verify, right? Because sometimes you come to a place, third world country. I'm not saying anything about Nigeria. And all kinds of, they say that the guy died, the only thing they found was the shoe, and then they want to collect the money, and the next thing you know, the guy is living in Mississauga, right? So there's a lot of things going on in places that are less controlled, and they're already aware of it, so it might delay the process. Okay? They need to verify it. But here, when it happens, it's very fast.
But you just make a change of address where you're at, so they'll know where you say you get married and you go to the area and you want your beneficiary as your wife. As long as you make a change of address, put your current address, the money will go to her. Once it's settled, like once they have proof that she did die, that she just sent them a death certificate or something, then they will send the money to her directly.
Usually when someone moves, whoever is a financial advisor will tie all these loose ends to make sure that they are addressed, change of address, make sure you're aware of the currency, and making sure that we don't run into obstacles that can happen. Okay? So this facilitates and makes it much easier. Okay. Any other questions on tax deferred income on the GPS process?
Not sure if I think I missed the point on the RSP meltdown.
Yes.
So once you have your money in the RSP, so technically you're allowed to move it into a non-registered plan? Okay.
See, when you have money in an RSP, although...
So it doesn't have to be a RIF. I always thought it has to be.
It doesn't have to be.
Okay.
We usually, when you're doing that, we call it a systematic withdrawal plan, okay? Which is a RIF also. Basically, you have an RSP, doesn't matter what age you are, and you say, I want to do the RSP meltdown. Usually we structure it over 15 years, okay? Ideal time to do it, not to down over 15 years, but it could be more if you're younger. And all we do is we go, we set it up, and we go to our RSP holder and say, look, I want a systematic withdrawal. I'm going to set up a systematic withdrawal. It's your money. When you withdraw money, you have to factor the withholding taxes and whatnot. Just to bring that in. In doing this, right, what's going to happen at the end of the year, in this example, we're taking $500 out, right? At the end of the year, because you took $500 per month out of your RSP, you're going to get a T4 RSP receipt to report $6,000 for your taxes. Okay? Now that's washed out by this, because here you're paying $500 interest on an investment. When you borrow money to invest, the interest is tax deductible. So it's in and out. Your RSP holder sends you a T4 RSP to report the $6,000, and you've got $6,000 to deduct, so it's a wash. There's no effect tax-wise. Okay? So this is why it works. So cash flow-wise, it's not costing you anything. This is coming out of your RSP. From a taxation point of view, you're not paying $1 more in taxes because this is being reported, this is being deducted, cleans it out. And then at the end of the day, your RSP is melted down, and it's all become non-registered money, and all you do is see the capital gain on which you pay only 50% tax, and you end up with 5 times more. Okay. Now, 5 times more. Instead of 50,000, you end up with 250,000. A lot more money. Your pool just got bigger. And you want to, because when you're ready to hang up your shoes, we really don't know how long we're going to live, right? We want to make sure that the more it is there, the more peace of mind we have. And if we pull out all the variables such as interest rates and stock market, volatility and whatnot, you have peace of mind. Any other questions? No? Okay, with that, I'm going to bring this to a close. Thank you very much for coming. I know you had choices with your time this morning and you chose to be here. And I appreciate that, and I want you to know that I'll never take that for granted. Okay? I'm here to help you move. I'm here to help you move ahead financially, and this is what we're going to be doing. Our mission is to empower people financially, and especially to make them aware that there are biblical principles that you can adhere to that are much more solid than what's being flouted out there. Okay? So the GPS process is based on biblical principles, and our mission is to empower people financially as an alternative to what's being flouted out there. Okay? See, and you can help us by being our advocates. Okay? You come here, and if you found value in here, over the next 90 days, you're going to be brushing shoulders with people who are living from paycheck to paycheck, okay, who are in debt, who do not budget, who do not have a financial goal, who do not have a financial plan, and you can help them. You can help them by talking, sharing what you learn, and think about Boston's grasp of the reverse debt. And it's a smart guy, people make no mistake about it. And the fact that he's absorbed it so well, and he can share it with people, okay? Only people around him, and empower them, okay? So that they won't fall into all these traps, right? And so speak to them, bring them, and we'll go in a different direction, okay? So have a wonderful next 90 days. A lot's going to happen. The holidays, hustle, bustle, winter, and we'll see you in the second week of January. Please complete your survey. Yes, survey and the action steps. In the action steps, you'll notice that the first action steps have to do with changing your thinking. Okay, it's adopting the GPS process. The only thing you really have to do over the next 90 days is read one book. Okay? And that's very minimal. And that book, Good to Great, that we're suggesting that you read. There was a financial advisor in Toronto who was 68 years old. And I heard him speak once, and he said, next to the Bible, that's the best book he ever read. So he thinks so highly of that book. Anyway, so you have a good holiday, and we'll see you in the second week of January. God bless you.